So, a friend who knows that I do this show with you guys every single week texted me a screenshot of an ad he saw on Facebook. It was for a free webinar. And by the way, I did email it to you. Do y'all have a chance to look at it?
Yes.
Mhm.
Okay. It was for a free webinar titled Don't Roth Convert, excuse me. Learn how you may be able to eliminate taxes on IRAs, 401ks, and 403bs instead. Don't Roth convert, it says. So is a webinar like that worth watching? Because we hear so much about Roth conversions.
You know, everybody has an angle. You've got to have, in order to stand out with all that comes out at us every single day, whether it's on radio, whether it's on television, whether it's on a podcast, whether it's on a YouTube channel,
Mm-hmm.
or something that you see as an ad on Facebook. I mean, all those are things that we see constantly. So in order to stand out, you have to do something to grab people's attention.
Right.
And
True.
what grabs people's attention more than eliminating
I love the elimination. Yes, if that's possible.
tax elimination? Yes. They want to get noticed. Well, apparently your friend noticed it enough to send it to you, right? So it is an attention getter. Eliminate taxes on IRAs, 401ks, 403bs instead. And I just wish that was actually doable. But there are only two guarantees in life, right? And they are
Death and taxes.
Taxes.
taxes. So you cannot avoid paying tax on IRAs, 401ks, 403bs, deferred comp, or any other retirement plan that's tax deferred. So you can't avoid paying tax on it. You can't. But you may be able to reduce taxes on that. And so how do we do that? Well, one of the ways that you do that is with strategies. And there's those who look at taxes in the rearview mirror. They look behind them and they say, okay, here's what you did this past year, and here's how much tax you owe. And you would call those people tax preparers.
Mhm.
Okay.
Or you can talk with somebody who looks from this point forward and starts to look down the road a bit and says, okay, what could taxes look like in the future for you? And start planning with strategies to potentially reduce, in some very, very small instances, eliminate. Now, how could you eliminate tax? Well, let's say if you're married and you had no income and you have a $30,000 standard deduction, and you pulled money out of your IRAs, $30,000, and that's all you needed to live, and you used your standard deduction to eliminate that. In that instance, you would end up not paying tax on money that you pulled out of those retirement accounts. But I don't know very many people who have no income otherwise that could live
Right.
on $30,000 a year.
It's not
So,
much
right,
living. I mean, it's existing to a
right,
degree, maybe.
exactly. So when it comes to our tax bill for our retirement accounts, there's basically three ways that you can handle this. One is Uncle Sam's plan. Well, what is Uncle Sam's plan? It's deferring until you're age 73.
Right.
And then you begin taking what are called required minimum distributions. So you take what Uncle Sam tells you each year you need to take out based on the previous year's end of year balance. And there's a nice divisor they use to calculate that bill. So I've got in my
What is that?
clean hands today a Roth conversion report that I did for a couple.
Okay.
Who is that
Rush
over there?
Limbaugh.
Rush Limbaugh,
Yeah.
Yes, I've got all my brain time behind my back, so
always.
just a minute here. But this couple, they were both age 56. The husband transitioned jobs, and he had $1.1 million in an old 401k that he rolled over into an IRA.
Okay.
So we did a Roth conversion report for him. And if he just followed Uncle Sam's plan that we just talked about, and he lived to age 95. So at least one of them did. He or his wife. Then and they averaged 7% a year in their portfolio. So those were all the gory details there. And he lived to 95, or one of them did. Required minimum distributions over their lifetime plus IRMA fees for Medicare would equal $1.410 million. So $1,410 and $294 on top of that. So that was the tax bill following Uncle Sam's plan. So then there was another plan, and that was to just take a level income out. Instead of waiting, let's start taking $92,216 a year out now, or in his case, when he's 59 and a half, and start pulling that out. During his lifetime, he would pay $591,344 in tax.
I mean, that's a huge difference.
It's about an $800,000 tax savings.
Gosh.
Or do a full Roth conversion plan over 10 years, and the tax bill would be $291,781.
Wow.
We cut the bill in half again simply by a Roth conversion strategy. We're talking about over $1 million saved with a Roth conversions strategy versus Uncle Sam's plan. So having a plan for taxes and not just leaving it up to chance, not just leaving it up to whatever Uncle Sam wants us to do, can pay off. So what makes the most sense? Now, you know what's interesting, Kristen, is that just last week, I met with a couple again, and I've had so many of these stories here within the last year or two of couples coming in or families coming in or individuals coming in that tell me the same thing. And that is, I wanted to do this 5 years ago, 10 years ago, 15 years ago, even 20 years ago. And my advisor talked me out of it.
Yeah.
There's advisors that are not only telling people the benefits of Roth conversions, but they're talking them out of it. And they said, this couple said when there was only $300,000 in there, I wanted to convert. And they talked me out of it. What would my tax bill have been over my lifetime had I done it then? I said, you don't want to know.
Well, there'd be less.
You don't want to know.
But the reason my brain's always thinking about why, but there'd be less money in the account to manage if they converted, wouldn't there?
Well, there would be.
Yeah.
Or, in some ways, I feel like it's a little bit of laziness. You don't want to learn about something, so you just don't recommend it, or you don't take the time.
Or pulling in an accountant like we do and having them help with the planning.
Yes, or having a certified tax specialist on your team that can help with those kind of things.
We have not talked about that. Yeah.
Yes. So, all those things are vitally important as we go forward and try to make sure that people are getting the best advice. Now, I will say that I met with a couple probably 3 or 4 weeks ago now. Time just kind of has a way of meshing itself with me, but it does. And I sat down with them, and they had saved about $750,000, done a pretty good job, and they needed, though, $40,000 a year to maintain their lifestyle. So that took about $500,000 to protect the income they needed for their retirement. That left about $250,000 left over. So in their case, I didn't feel like Roth conversions were a good idea, because if we did the Roth conversion, and almost all that was tax deferred money, but if we did a Roth conversion, they were going to drop their asset value by about 20%. And I didn't feel like they could afford to take the hit on the asset side. So in their case, by needing the income, we're going to do the steady income stream version, which is still going to cut their tax bill by almost 2/3 over their lifetime. So that's still going to help cut taxes versus Uncle Sam's plan. But it didn't make sense to do Roth conversions because I didn't feel like they could afford to take the hit on the asset side. So as their advisor, I advised them against it because and they were going to need income within 2 years. So we really didn't have time. And by the way, every time you do a Roth conversion, there's a 5-year wait. before you can touch that money. And so in their case, all those things together didn't really make sense for a Roth conversion for them. So whenever you go online and you see, okay, this thing where it's a one size fits all type situation, don't believe it. Understand that your situation is unique to you, and you need to have a planner in your corner that will take all things to account and give you the right advice based on your personal situation.